Inflation just hit its highest level in 13 years. While this only makes most people poorer, you're going to learn how to profit from this truth. Hi, I'm Keith Weinhold. This is Get Rich Education. Welcome into this third of 3 videos in this original Inflation Triple Crown 3-part video series. We're talking about how you benefit from inflation 3 ways at the same time when you buy a piece of rental income property with a mortgage loan on it. The first of those 3 ways is price inflation, which we talked about in the first video. The second was debt debasement. This third one in this video, we're focusing on the cash flow enhancement benefit and why it's the most important of the 3 parts of the Inflation Triple Crown. Yes, it takes debt. It takes a loan in order to make all of this work. Well, when is debt good? Really, there are 3 instances when debt is secured, meaning that there's a piece of collateral tied to the property, like real estate, which never goes to zero. Even if it burnt to the ground, you still have the land that's worth something. The second is when the interest rate is lower than the rate of inflation, which actually can be true in some cases today. When your interest rate is lower than the rate of inflation, the rate at which you pay money to the bank, those dollars are deflating even faster than bank interest can accrue on you. And the third way that debt is good is when your debt is outsourced to a tenant. When you buy a cash flowing property, the principal, interest, and a little part on top of that called cash flow is all outsourced to a tenant. That's what makes debt good. You can have all 3 at the same time with the type of debt that we're talking about here. It is really good debt because it makes you wealthier. Now, in the first 2 videos, we talked about how a mortgage can make you wealthier, price inflation, and cash flow enhancement. That focus more on what someone would think of as your net worth statement. Your net worth statement is basically a column of all of your assets minus all of your liabilities, the difference between those 2 numbers being your net worth. In the first video with price inflation, that increased your asset value even faster than inflation when you took out a loan. And in the second video, debt debasement, that debased your debt more quickly with inflation. They're in the liability column of your net worth statement. Here with cash flow enhancement, we're not looking at your net worth statement, we're looking at your cash flow statement. On a monthly basis, what's your income and what are your expenses? So that's the relationship that we're looking at here with the third in the Triple Crown, cash flow enhancement. And this is a really timely video because the government just reported that the CPI, the Consumer Price Index, which is sort of their headline inflation measure, just hit 5%. Yeah, it's highest in 13 years. Now, this is partially due to low base effects because inflation was really down last year, but this is still significant and worth paying attention to. So inflation is a real thing. And some of the inflation items that are increasing more quickly than the CPI are things like energy, stocks, asset prices like real estate, healthcare, childcare, tuition, housing, used cars, airline tickets, construction, and remodeling supplies, all outstripping the CPI. And then some of the more deflationary items like consumer electronics, they tend to be a smaller portion of a household budget. You know, before we break down the numbers here with cash flow enhancement, something so interesting happened to me just yesterday. You know how in the first of these 3 videos I talked to you about how a tip was now being asked for the Qdoba burrito that I give every week. That was some service inflation. But just yesterday in Subway, for the first time ever, Subway wasn't asking me this question just 1 month ago. They asked me when I went to pay for my Subway sandwich, would you like to leave a tip? 15%, 18%, 20%, a custom amount, or skip it and leave no tip? But I had not been asked that question before at Subway. That measure is probably not reflected in any of these conventional inflation measures, as well as that adding to the consumer cost of items. That is some stealthy inflation right there at Subway restaurant. Now, with any sort of investment arrangement like you taking on a mortgage loan, it's prudent to talk about what are the risks associated with that investment. The risk is, now what if real estate values go down and you've taken a loan on this property? Remember, you bought for cash flow, so even if the capital value of the entire property goes down, as long as you have that tenant rent payment and probably an income stream that you're producing from it, you're better off, and you wouldn't want to sell the property if it were temporarily suppressed in value. Housing prices are more stable than stocks and a lot of other investments. Rents are even historically more stable than housing prices, because if housing prices do go down, more people are discouraged from buying and they want to do what? Rent. So if rents go up, you're closer to financial freedom. Let's take a look at this. Let's break down some numbers. This is what inflation does in enhancing your cash flow. Let's say you have a property with $1,000 of rent income and $800 of expenses on it. Therefore, your cash flow, also known as your passive income, is $200 a month. Let's take a look at those $800 in monthly expenses that you'd have on this rental property. A $400 mortgage. And typically you might have something like $100 for property insurance, $100 for maintenance, $100 for property tax, and $100 for management. Your property manager makes this virtually passive for you. That's where we come up with your $200 of cash flow. Let's say then we have 10% inflation. So we're going to fast forward, say, a couple years. I doubt we'd have 10% inflation in 1 year, but let's say we get 10% inflation over a couple years. Let's take a look at what happens to your numbers. Your rent income goes from $1,000 up to $1,100. Your monthly expenses, let's see how they're broken down. You still have a $400 mortgage payment, principal and interest. That is fixed, and that is key. That does not adjust to inflation. Here in the United States, we have this benefit of this long-term fixed interest rate debt where you have payment certainty for 30 years, and that payment does not go up with inflation, so it gets easier for you to pay back over time. And then your other expenses, property insurance, maintenance, property taxes, and management, all went up 10%, so they're each $110 now. What's that do to your cash flow? Now you have $260 of cash flow. Well, look, a couple years ago, before the inflation kicked in, you had $200 of cash flow. And again, how did that happen? How did that go up more than 10%? That's because your biggest expense, that principal and interest, stays fixed. That's the beauty of it. That's the certainty that you have for 30 years. So therefore, $200 versus $260, look, with 10% inflation, that cash flow grew 30%. But you might say it's only $60 a month. That's true. But here's the real point. Your passive income, the money you feel in your pocket every month, grew by 30%. You 3x the rate of inflation. So just extrapolate 30% passive income throughout your entire portfolio of properties. And again, why did this happen? With that loan, your principal and interest stays fixed, so that if there's no loan, there's no cash flow enhancement benefit like this. It's something really important to understand. Look, this is how wealth is created. This is how you get financial freedom, which is defined as you having so many income streams residually that you don't even need to be involved with for the production of that income, that you can do what you want to do when you want to do it. That's why I say financially free beats debt free. You want debt like this. You know, most people that scream that they're debt free after years of grinding and working hard and sacrificing their quality of life, every person that I hear say that is not living a high quality of life, not living an expansionary lifestyle, and they're living with limits. However, every financially free person that I know is living their days as they wish. You don't want to retire your good debt. What you really want to do is live your days as you wish. That's freedom. That's a great definition of success. Financially free beats debt free. Hey, if you're getting some good value of this, put a like on this. I would really appreciate it if you put a YouTube like here. That tells YouTube that it's a good video, and it also makes it more likely that videos like this will show in your feed. And you might be putting that like on because you really like inflation now, something that really just debased your wealth previously. And you know what's interesting? We just broke down some numbers with some very simple math. I've been investing in real estate directly myself for 19 years. I've only used the simplest math operations. All these calculations for real estate just involve addition, subtraction, multiplication, and division. In my entire real estate investing career, I've never used exponents or trigonometry or calculus or square root symbols or anything like that. This is simple stuff. Now, I talked about a risk earlier if housing prices go down. One other risk is deflation. Doesn't that make all of this fall apart? Are there any prospects for deflation? How does that look? Globalization and technology are two deflationary phenomena. With globalization, something that didn't really exist so much 50 years ago, we've now opened up where we have billions of people that could work for as little as $5 a day. Well, that's really deflationary. So that really sums up the globalization portion of what could create deflation. But the United States and central governments can just print like we've been doing even through this era of higher globalization. That's why we still have inflation. It's very easy to print. That's what we can do in the long term. And then in the short term, coming off this recession like we are, pent-up demand drives inflation. More demand, more dollars, more bidders effectively, more competition bidding up the prices of things. That's really what happens in an economy as it revs up. Businesses need to go ahead and offer higher wages as well, effectively being a bidder to try to take them away from another prospective employer as the economy heats up. Long-term printing keeps inflation on. Short-term pent-up demand keeps the inflationary pressures on. And you know, every currency eventually goes to zero. No currency lasts forever. I think the British pound is one of the longest enduring world currencies. What really happens? Why does all this printing and all this inflation take place over time? Well, really, as governments grow, bureaucracy grows, and that gets inefficient, and then debt grows, and then in order to get our way out of our debt, people and governments print. So that's why the United States prints. We have about $30 trillion in debt in the United States right now. And just hypothetically, let's say 10 trillion of that is debt to China. Well, as a government, we could do a few things about all this debt that we owe to China. We can just walk away from it and say we're not going to pay it. You can imagine how politically unpopular that would be. The politically expedient thing to do is just print more dollars. We're not on a gold standard. We can print unlimited dollars in the United States. And of course, when I say print dollars, it's usually not the physical printing of ink to paper. It's currency creation. It's just strokes on a keyboard. That's the easiest way to debase our debt. And governments have a history of doing this. About 100 years ago in Weimar, Germany, so the story goes, is that the German mark got devalued, debased to such an extent that a shopper that was walking along the street had to put all their German marks, more than 10,000 of them, in a wheelbarrow. And as they wheeled that wheelbarrow up the street and they set it down on the sidewalk outside a bakery so that they could take this wheelbarrow full of money just to buy one loaf of bread with some tens of thousands of marks, call it. The story goes, someone came by, dumped out the wheelbarrow of cash and took the wheelbarrow because that had more value than the cash inside it did. This is what often happens over time. A more recent example is in about 2009 in Zimbabwe. The currency got debased so badly due to profligate spending and government misbehavior that the inflation of the Zimbabwe dollar, hyperinflation I should call it, was 80 billion% per month, not per year, on a month-over-month basis. In fact, I have, because I found this so interesting, I bought some Zimbabwe dollars. This is a $10 trillion Zimbabwe note right here. This is an evidence of hyperinflation that we saw here in Zimbabwe. There are more recent examples in 2018 in Venezuela with their out-of-control government. The currency got debased in the Venezuelan bolivar to such an extent that people were actually buying currency in the game World of Warcraft just to try to hold their purchasing power and maintain it there in that phony currency. So these are just some pretty extreme examples of what can happen, but I mean, come on, what do you really think is going to happen to the United States dollar? In fact, let's put that chart back up here that we showed in the first of the 3 Inflation Triple Crown videos. Let's just take a look here at about the past 115 years. What's the history of the dollar? So if we want to try to predict the future, let's look at the history and maybe try to draw a line through its trajectory. We're probably not going to get hyperinflation. We have not had any hyperinflationary periods here. We have had some brief, mild deflationary periods, like in the 20s and 30s, especially around the Great Depression. We also had high inflation, not hyperinflation, but high inflation, 10% or more at times. And some of those higher inflation periods were in the 1940s, the 70s, and the 80s. So really, what's the most reasonable or likely future trajectory of the dollar? Well, we're probably not going to have hyperinflation or substantial deflation. I think it's a pretty reasonable thing to say based on history. The most likely outcome is that we would have continued mild or moderate inflation. The government really does not want deflation because that makes all of their debts weigh them down even more. So you might hear stock investors say something that sounds pretty sophisticated, and a stock investor might say, I'm going to go short this stock. What does that really mean? That just means that you're betting that that stock is going to go down in value. That's what shorting a stock means. So here, when you're a prudently leveraged borrower for cash flowing real estate, what you're doing then is you're shorting the dollar because you're making an educated bet that the dollar is going to continue to decrease in purchasing power and lose value over time. You're shorting the dollar. And there really aren't very many guarantees in investing at all. And continued dollar debasement isn't quite a guarantee either, but it's highly likely. It doesn't take a heavily savvy investor. It doesn't take prescience to know that the dollar is almost going to continue to trend down, 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 like we saw in the chart. History tells us that it is almost a sure thing. So inflation really for you, it is why you are about to be wealthier. So before I give you the conclusion here to the inflation triple crown, hey, all this knowledge won't help you that much if you don't apply it. But if you wish this sort of conversation just continued, listen to me on the Get Rich Education podcast. I've released a new show every Monday for years. It's one of the most listened to shows on real estate investing. That's kind of what we major in with minors in wealth mindset and real estate economics. With millions of downloads, I've had some of the best known people in the finance business run alongside me for a few episodes, like Robert Kiyosaki and Grant Cardone, and all of your favorite investing heroes there. GREturnkey.com is where I do my own property buying and where you can too. That's where you find properties with the best ratio of a high rent income to a low purchase price, typically where you can get loans on these properties. Properties made for cash flowing real estate investors. Turnkey means that a property is already renovated or it's brand new construction, already tenanted, and they'll hold it under management for you. That's what turnkey means. So as long as you're pre-qualified for a mortgage, you want to make sure you get that done first. Then you can go shopping for property at GREturnkey.com. Remember, in the first video, we talked about price inflation, the first of the three crowns in the inflation triple crown. That's where when inflation went up 10%, the value of your equity went up 50%, and that's how you made out. In the second of three videos, that was about debt debasement, where with an example given was $1 million in debt, you had a $40,000 phantom benefit from inflation profiting. And then today, in the third video, cash flow enhancement, we talked about how with 10% inflation over time, say a couple years, you got a 30% increase in your passive income that you feel in your pocket every month. That's the inflation triple crown. You know, inflation, debt, and taxes are three things that make most people poorer. We've turned that around, and with this series, you've learned how actionably to use inflation to make you wealthier. Most people don't know how to do this, so for most people, a dollar is just like an ice cube melting in their hand as it continues to degrade in value. And so now, you know, in the past you might have thought, well, inflation is bad or debt is bad. No, those things aren't necessarily true. Something like inflation, that's really just a tool, much like fire is a tool. If you went around saying fire is bad, well, that would sound sort of strange. I mean, fire can be bad. It can inflict a third-degree burn. Fire could even kill people if it's mismanaged or if it's not used properly. But much like inflation, fire is a tool. You can use fire positively to cook your food or heat your home or provide light in a dark night. Well, much the same, inflation can be used positively as a tool now that you know how to use it. Inflation's a tool, much like fire. It's good to have some liquidity in your life, always have some of that, but in general, inflation is why savers lose and borrowers win. In fact, Robert Kiyosaki, the greatest selling financial author of all time, this is why he says that savers are losers and debtors are winners. Your debt is outsourced to the tenant, and this really all revolves partially around why real estate investing gives the best risk-adjusted return anywhere, and it's done that for generations. Inflation is a factor in how you choose to allocate every dollar that you have for the rest of your life. Hey, I'd really appreciate it if you tell a friend about this video series. That does more than just bring them an awareness about what's going on in the economy and some good financial education concepts, but it really tells them about what they can do to increase their quality of life and increase their freedom, which is really the bottom line here. That includes the 3-part Inflation Triple Crown video series. If you want to be a subscriber to the channel, I would really appreciate that. I am producing more videos than I ever have in my life, and I plan to continue to do that, especially when it comes to showing you the numbers. I've been one of the most listened to real estate podcasters for years, but this really helps you with some numbers and with some other concepts. I am devoted to telling you how real estate creates real wealth for real people. I'm Keith Weinhold. Thanks so much for being here, but you weren't here for me. You were here for you. Thanks so much for stopping by.